Welcome back to the podcast. Today we're diving into a topic that every investor needs to understand: risk management. It's one of those things that sounds simple in theory, but can be a challenge when you're actually putting your money on the line. Balancing risk and reward is crucial, especially for beginners. So where do we start?
Absolutely. One of the biggest struggles for new investors is knowing how much risk they should take. It's tempting to want high returns, but it's also important to remember that higher returns usually come with higher risks. A common mistake is jumping into investments that promise quick, large rewards without fully understanding the risks involved.
Right. And this is where understanding your risk tolerance becomes crucial. Risk tolerance is essentially how much volatility you're comfortable with in your investments. Some people can stomach big swings in the market, while others might get anxious with just a slight dip in their portfolio. Understanding your own comfort level can prevent you from making rash decisions.
Exactly. And here's the thing. Risk tolerance isn't static. It can change over time depending on your financial goals, life circumstances, and investment experience. As a beginner, you might feel more comfortable with safer, more stable investments, like index funds or bonds. Over time, as you gain more experience and confidence, you might start considering stocks or even alternative investments.
You're totally right about that. But here's the thing. Don't let your emotions drive your risk management strategy. It's easy to get caught up in fear when the market is volatile, or on the flip side, to become overconfident during a bull market. Both extremes can lead to poor decisions. Staying level-headed is key to managing risk effectively.
That's such an important point. And I also think beginners tend to overlook the importance of diversification in managing risk. It's a concept we've all heard before, but what does it actually mean? It's simply about spreading your investments across different asset classes: stocks, bonds, real estate, commodities, etc. Diversification helps mitigate the risk of a single investment negatively impacting your entire portfolio.
Absolutely. Diversification is like a safety net. By having different types of investments in your portfolio, you're less likely to lose everything if one of them underperforms. A well-balanced portfolio can withstand market fluctuations without causing panic. But how do you figure out the right balance?
Great question. One way to start is by looking at your time horizon. How long you plan to invest before you need to access the funds. If you're investing for retirement and you're young, you might be able to take on more risk because you have years to recover from any potential downturns. But if you're investing for something short-term, like a down payment on a house, you'll want to reduce your exposure to high-risk investments.
That makes sense. And there's another factor here that beginners might miss: asset allocation. This refers to how you divide your investments across different asset classes to help achieve the balance of risk and reward that aligns with your goals. For instance, if you want to take on more risk, you might allocate a higher percentage to stocks. If you're more conservative, you might allocate more to bonds or cash.
Exactly. And speaking of conservative strategies, let's not forget about risk management tools like stop-loss orders or options hedging. While they can sound complicated, these tools are designed to protect you from significant losses if the market takes a sudden downturn. But as a beginner, you don't need to get too deep into these right away. Just understanding their existence can give you peace of mind as you become more familiar with investing.
Great point. It's all about starting with a solid foundation. For beginners, the goal should be to gradually increase your knowledge of risk management, as well as the different strategies available. And while it might feel intimidating at first, remember that risk management isn't about avoiding risk altogether. It's about understanding the risks, making informed decisions, and using tools and strategies to mitigate them as much as possible.
Right. Investing will always carry some level of risk, but by educating yourself, diversifying your portfolio, and staying disciplined, you can navigate those risks more effectively. So, if you're just starting out, don't feel pressured to take big risks. Focus on building a foundation, and over time, you'll develop a strategy that suits your needs.
Well said. Risk management is a skill that improves with time and experience. So don't be afraid to start slow and learn along the way. The more informed you are, the better equipped you'll be to handle whatever the market throws your way.
Absolutely. We hope this discussion has helped you understand the importance of risk management in your investment journey. Thanks for tuning in, and if you've got any questions or want to share your thoughts, feel free to reach out to us.
We'll catch you next time with more tips to help you invest wisely and confidently.